Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host, Desmond, and today we're shining the spotlight on gold, the precious metal that's been stealing the show. We've got a hot topic. Gold just hit a new all-time high this February 2025, and it's got everyone buzzing. What's driving this glittering rally and where's it headed over the next couple of quarters? Let's dive in. First up, the headline. Gold smashed through a new record high this month, peaking at $2,954.94 per ounce on February 20th, according to the latest data as of today, February 21st, 2025. That's a 40% surge over the past year, and it's not slowing down. We're talking 8 record highs in 2025 alone so far, with prices hovering around $2,940 as I speak. It's a golden moment, pun intended. But what's lighting the spark under this rally? Let's break it down. So, what's fueling this robust demand? Right, it's a perfect storm of factors. Number one, geopolitical chaos. From ongoing wars in Ukraine and the Middle East to trade tensions sparked by President Trump's tariff threats, investors are flocking to gold as the ultimate safe haven. When the world feels shaky, gold shines. Number two, central banks are hoarding it like never before. China, Russia, and others are piling into gold to diversify away from the US dollar. Think over 1,000 tons bought annually in recent years with no sign of stopping. Goldman Sachs says this alone could add 9% to gold's price by year end. And then there's the money angle. The Federal Reserve cut rates in December, but with inflation still lurking and Trump's policies, like tax cuts and tariffs stirring the pot, real interest rates are sliding. That makes gold, a non-yielding asset, way more attractive than bonds. Add in a wobbly dollar down against the euro lately, and gold's looking like the MVP of hedges. Oh, and don't forget physical demand. London's seeing shortages, and there are 8-week wait times to pull gold from the Bank of England. Someone's buying big, maybe even the US Treasury if the rumors are true. Now, the million-dollar question, right, or should I say the $3,000 per ounce question. What's the outlook for the next 1 to 2 quarters? Analysts are bullish, and I'm inclined to agree. Goldman Sachs just upped their year-end forecast to $3,100, citing central bank demand and tariff fears. If uncertainty sticks around, and with Trump's trade wars heating up, it might. We could even see $3,300 by mid-year. JP Morgan's pegging $2,950 as an average, with room to climb if the Fed keeps easing. But it's not all smooth sailing. If inflation spikes and the Fed pauses rate cuts, or if the dollar roars back, gold could face headwinds. China and India, big consumer markets, are also struggling with weaker currencies, which might cool jewelry, demand. Still, the consensus is upward momentum through Q2. Standard Chartered's Suki Cooper says rate cuts early this year could keep the tailwind going, though it might taper off by summer. My take? Gold's got legs. $3,000 feels like a when, not an if, barring a major curveball. And that's your commodity spotlight on gold. A record-breaking February, unstoppable demand drivers, and a bright near-term outlook. What's your bet? $3,000 by June. Until next time, keep your eyes on the markets. This one's pure gold. Thank you for joining us in today's episode. In the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, happy trading.